Cool. All right. So thank you very much, Frances Coppola, for joining me on Magic Internet Money. Frances is the author of The Case for the People's Quantitative Easing, which is a book that I have not yet gotten around to, but it's on my list because I started going down the path of trying to understand how central banking works by looking first at Central Banking 101, and then I started asking the author, James, about that, some questions on Twitter, and then you had joined in and you were giving some really great insight to me about really specific things about the nuance of how central banks work and how
Mm.
money moves around the plumbing of the financial system. And so I grabbed your book, and there's a long list of things. I'm trying to really understand it because as a Bitcoiner, you know, I came into this space of like trying to understand money from kind of like libertarian leaning gold bugs and stuff like that, where it seems like I might have been given some bad information when I started to learn about money. But then as I learned more, it seems like a lot of people were given bad information about it, and the idea of the money multiplier and like
Mm.
how money and credit is created. It seems like it's a shifting consensus view almost that like
Mm.
even the central bankers don't even really know how it works until after the fact somehow. So you seem to have like such a good concept of how this works globally that I'm thank you for coming and having the conversation with me.
Our pleasure. Well, I think your observation that even central bankers don't really know how it works is probably quite astute. Because if I can just take you on a ride back to the great financial crisis of 2008. And then we had the era of QE after that. And I can remember in the years after that, I used to have endless arguments with gold bugs. All the gold bugs now seem to have disappeared and they've morphed into Bitcoiners, but the arguments are essentially the same. But at the time when central banks first started doing QE, they didn't know how it worked. They were making assumptions about how they thought the banking system worked, which is not how it actually works in practice. So the money multiplier that you mentioned is based upon the idea that if you give banks what we call reserves, which is like cash produced by the central bank, then banks will lend that out, or rather they'll lend out a multiple of it. And the money multiplier is the idea that there's a certain multiple that they can lend out, typically 10 times. And the way this is explained is if they get a deposit in, they will keep 10% of it in reserve and lend 90% of it out. Or you can express it another way, say they've got £10 in reserve and they can leverage that up to make £100. I'm using English terminology here, obviously. So if you've got $10 in reserve, you can leverage that up to make $100 worth of loans. That's often how it's explained. That's not actually how lending works. What banks do when they lend, and to explain this, I just need to take you on a little bit of a double entry accounting ride, is when they lend, they create a loan asset, which is debt, and is the obligation of whoever they're lending to repay it and to pay the interest on that. So in the future, there's going to be a stream of cash flows, which will be the interest payments and the eventual repayment, which might be a bullet repayment at the end of the loan, or they might be repaying it in installments throughout the loan, right? And at the same time, banks create a new deposit, which is the actual money of the loan, and that goes into the borrower's checking account, and then the borrower can draw it whenever they want or need to. Right, that's actually how lending works. So you've got a deposit and you've got a loan asset. The deposit is paid away at some stage, it goes into another bank, whatever. The loan remains and is then paid back over a
Is it
period of
accurate
time.
to describe the money in your bank account as not actually money at all, but really just a liability on the bank's balance sheet?
Well, I think that actually this is one of these both statements are true thing. It is a liability on the bank's balance sheet. It's not, in that sense, it's kind of not your money. When you have a deposit in the bank, you've kind of made a loan to the bank. You are one of the creditors of the bank. But it's also money in the sense that anything in your bank account you can use to pay for goods and services. And that's really the fundamental purpose of money, is that you can use it as a medium of exchange, that you can pay for a coffee in Starbucks with it. And you can pay for a coffee in Starbucks with greenbacks, with physical cash, or you can pay for a coffee in Starbucks with a debit card. As far as Starbucks is concerned, it's the same. So the money in your bank and the money and physical cash in that respect are the same thing.
I definitely like, it's kind of like a thought exercise, really, more than like a legitimate statement. Obviously, like, money in the bank account is money that you can use, but with like the way I think about it, it kind of feels unfair to me as a Bitcoiner and someone who's like anti-authoritarian in a way, and feels like the wool's been pulled over my eyes with the whole banking system. It feels like the money in my bank account, especially if it's over the limit of FDIC, or here in Canada, CDIC,
yeah,
is not actually like the same as having physical gold in your house, or greenbacks, stacks of cash, because there's bank bail-in provisions and stuff that makes it so that you could lose that money, which has happened all over the world.
Yeah,
in times of bank crisis.
Okay, there are two parts of this. The first is that where you're dealing with solvent banks, there is the par guarantee.
What's a sovereign bank?
A solvent bank, a bank solvent. That is actually a going concern, right?
Right.
As long as your bank is solvent. We'll talk about solvency in a minute, because you kind of touched on this already, right? But let's assume for the moment we're dealing with a bank that is completely solvent. It doesn't have any. It's not going down in a minute. It's like banks are most of the time, actually. You have a guarantee that you can exchange the money in your deposit account for physical currency at any time. You can exchange it at par. There's no exchange rate between the two. Now, because a bank is a commercial institution, there is this tail risk that it could be insolvent and you could lose your money. Arguably, the money in your bank account should not be worth as much as physical cash, but because you've got that guarantee, that government guarantee that you can always exchange it at par, there's no interest rate there's no exchange rate between the two. There is an interest rate because the money in your bank account, I know they earn nothing at the minute, but in normal times, money in bank accounts, and bank accounts does earn some interest, whereas of course physical cash earns nothing at all. So that's
interesting. I've never
kind of compensates you for the risk you take.
So I've never thought about that before, because I grew up in a system where you don't get interest on the money in your bank, or it's so de minimis that you just don't even notice it. Was that an idea from like before interest rates were artificially kept low, that
it kind of depends a little bit where you are in the world, because I mean the US, for example, has always had a rule that what it calls demand deposits, which are checking accounts, are not allowed to bear interest. But here in the UK, checking accounts do bear interest. Earning nothing, but way back when, before the financial crisis, before this era of ultra low interest rates, they did actually pay interest.
And that was to compensate you for the risk of keeping it in the bank account. But what were they doing with that? Was that at the time when fractional reserve banking was kind of happening, where those deposits were being lent out fractionally, or did fractional reserve banking just never really exist and we thought
no. Fractional reserve banking kind of doesn't exist the way people think of it. But banks don't lend out deposits like that. It's more to do with balance sheets, which is why I said you need an understandable entry accounting, really. That banks lend. It is their job to lend. I don't think anybody would argue with that. A bank lends and a bank takes deposits, and it earns its profits on the spread between the interest rate that it earns on lending and the interest rate that it pays on deposits. That's fundamentally how a bank works. That's what it does, right? So you've got a balance sheet which has got risky assets on it, mostly loans, and you've got and on the liability side, you've got deposits, most of which are money that people put in the bank or that they have because they borrowed from the bank.
Right.
The tension the problem for depositors is that they want that money to be safe, whereas the bank, by definition, is taking risk in lending. And because it is a balance sheet, and then if you know something about balance sheet accounting, you know that the solvency of any company really depends upon whether it has sufficient assets to meet its obligations. So if all depositors try to remove their deposits all at once, and we should bear in mind that not all deposits can be removed at once. There are such things as time deposits, things that you lock up for a period of time. You might, go into a savings account which matures in 3 years' time and pays you a higher rate of interest than you get on your bank account and your checking account, right? And that money can't run. You can't just go along and withdraw it, or if you do, you're going to pay a penalty. But for demand deposits, checking accounts, and instant access savings accounts, people can go to their bank and say, right, I'll have my money now, or they can take it out online or whatever. Now, everybody did that all at once. The bank would have to come up with the money, right? Its problem is that it's on the other side of its balance sheet, on its asset side, it's got a huge pile of risky, illiquid assets like mortgages and loans of various kinds, and it hasn't got much in the way of cash. It has sufficient cash to cover normal payments, and that's what we call reserves. That's what reserves are. They are the bank's cash, if you like, that holds on its.
The reserves, because as I'm learning about it, I'm realizing there's two types of reserves. There's like central bank reserves, and then there's bank reserves. And I guess the bank reserves are like assets on the banks, like cash, like instruments that can be easily liquidated, like U.S. Treasuries and cash, like equivalents that the bank owns that it can liquidate to meet demands of withdrawals from normal expected demands, right? But then the bank reserves, the central bank reserves, are what people are now saying is not actually increasing the money supply because it's kind of trapped inside of the Federal Reserve system and not happen. It's not causing inflation because it's like stuck.
They're actually the same thing, but if I can explain why, I'll get there in a minute. They're actually the same thing, right? Okay. But if I can just talk through what bank reserves on the bank balance sheet do, and they are the money that banks use to make payments. So obviously, if everybody tries to withdraw their deposits all at once, banks need a lot more money than they have readily available on their balance sheets, right? So they have to go and get some. So what they have on their balance sheets is other things like treasuries and things like that they can pledge to go and borrow money. And if necessary, they can go to the central bank and get some money and so forth. And that's when we talk about lender of last resort for banks. That's what we mean. It's the central bank saying, if everybody tries to pull their deposits all at once, we will step in and lend you some money so that you can meet their demands without going bust. Close your doors, right? It's an essential support for banks that central banks provide, and that in the past, certainly in 2007, which is when the great financial crisis actually started, they weren't too good at providing. I mean, the reason why in Britain we had an actual physical bank run on a bank called Northern Rock was because the Bank of England actually was a bit kind of wobbly about providing this assistance, and somebody leaks it to the press.
And people panicked.
Yeah, it was complete panic. In fact, runs like that used to be called panics. It's very interesting. I mean, but bank runs can be legitimate. I mean, if a bank is going down, it's totally legitimate that people want to remove their money. One of the reasons we have deposit insurance is actually in a way to reassure people so they don't feel they need to withdraw their money if things start to look a bit wobbly, because it can actually often be better to provide a bank with liquidity and see if it can kind of get itself out of its difficulties. But if it's actually insolvent, then we're in the business of bailouts, or we're in the business of some form of resolution. And it's not always that easy to tell when you've simply got a liquidity crisis, whether the bank is just experiencing a run because there's some kind of panic going on, or whether it's actually insolvent, and it can be some months before you find out, as was the case with Northern Cross. Actually, it took 5 months to determine that it was actually insolvent.
So it was it was insolvent, and then what would happen in that case where it's insolvent and it's not its reserves or its obligations to the customers are over the amount of what's in FDIC or whatever the equivalent is in the UK? Like, what happens there? The government just comes in and backstops it with the money printer? Like, how does that?
That's what happened in that's what happened in 2008, but it's not backstopped with the money print with central bank money printer. It's actually backstopped by taxpayers. That is actually taxpayers' money, government money, that bailed out banks, not central banks.
Is that bonds?
Central banks provide liquidity. So central banks can lend money to banks.
Right.
But if a bank needs more what we call capital, which is a slightly misleading term, but for people who are familiar with corporate balance sheets, the gap between assets and liabilities is their equity. Yeah, so you have, as a corporation, you have assets, and you should have a rather smaller number of liabilities, and the gap between the two is your equity, and it's owned by your shareholders.
That's the part that I'm confused by when I try to look into banking, because there's liabilities, assets, and equity.
Yeah.
And it's kind of like the way that I would look at it if I was just, didn't understand it, I would see banks have made loans. That is a future stream of income for the bank, even though they've made that money from nothing. Really, they've just created that money from nothing when the loan is issued. That is an asset because it's gonna be interest for them, right? It's also a liability because the customer's money is a liability, right? And then there's this central bank part of the balance sheet too. Like, there has to be bank reserves at some point to backstop or to
those are assets on a bank balance sheet.
So the bank reserves are the assets?
Yes, bank reserves for a commercial bank, central bank reserves are assets. They're on the same side of the balance sheet as the loans, right? So if you think about it, so you've got your bank reserves, which are assets, they're cash, which is an asset, and you've got your risky loans. And then the other side of the balance sheet, you've got your deposits, and you might have other forms of lending like bonds that you've issued, and maybe some repo money that you've borrowed in the markets, right? And then you should have a gap between the assets, your loans and your cash, and your liabilities. And that gap, that difference, so your liabilities should be smaller than your assets, right? That gap is your equity. It's what it's your shareholders' funds. And when a bank gets in,
go ahead, carry on. So I was just thinking, like, how is it possible that a bank couldn't have equity in that scenario then? Because banks literally make nothing, like money from nothing, right? They create the money. So how could they not have equity?
Well, if you think about it, if a bank's balance sheet consisted entirely of loans and deposits, it would have no equity, right? Because every loan has an equal and opposite deposit, right?
But wouldn't it be the interest that they're getting paid on the loans? Right. Wouldn't that add up on their equity side? Yes.
If I can just talk about, supposing you set up a bank from scratch and you lent a bunch of money, right? Yeah. So all you would have on your balance sheet would be the loans, the loan assets, and the deposits, right? Nobody's drawn the deposits yet. Well, that might be a bit problematic if you hadn't got any cash. And you wouldn't have earned any interest. So all you would have would be a pile of loans and a pile of equal and opposite deposits, and you would have no equity. The two sides would balance. There would be no gap between them, and you would have no equity. Right, you would have no shareholders' funds. As your interest comes in, right, you would start to build up what we call retained earnings, right? So your equity, and that would so you would start to have cash assets from your interest payments, and on the other side, that would be balanced up by building up what we call retained earnings, which are money that you actually own, that your shareholders actually own, and that comes from your net income, which in this case would be your interest income, and that can build up over time. So a bank that's lending sensibly and doesn't have lots of defaults and things like that should be earning its net income from the difference between the amount of interest that it charges on loans, interest income that it gets on loans, and the amount of interest that it pays on deposits. That's where its income comes from. Over time, it builds up in the form of cash, and it goes into their equity, right?
Right.
It's not quite that simple, but that's in theory how a simple banking model works. Banks
That's easy to get when we start from scratch like that. So like also what is the relationship there with central bank reserves when that bank starts and it makes a bunch of loans? Let's say it makes $1 million of loans, it's a new bank. How
it's
does
got
it
to actually physically let those banks be paid, and it hasn't got any cash, right? So
does it just like borrow quickly like
Yeah.
through the repo market or something, $1 million of central bank reserves and pay a small interest to the bank that
It
actually
might
has
borrow
the
it through
reserve?
something like that. It'll borrow $1 million of bank reserves through the repo market, or directly from a central bank, or if it hasn't got much in the way of things it can pledge or whatever. That's kind of what banks do, is they will borrow reserves. And in the olden days, before we had all this QE stuff and excess reserves, which we'll come on to in a minute, in the olden days, before 2008, in some countries, not all, but in some countries, including the United States, we used to have what we called a reserve requirement. And the reserve requirement basically said you must have, as a bank, sufficient reserves to cover a proportion of your deposits. So anyway, we're saying that you must have, in the case of the US, it was 10%. So they had to have sufficient actual cash reserves from the central bank on their balance sheet to cover 10% of their deposits. And that would mean they'd have enough money for 10% of their deposits to be withdrawn all at once.
Right. That makes sense. Like even that though, to me seems kind of nuts that you would only be required to, it seems very risky to have such a small reserve requirement.
Like I said, it doesn't cover the eventuality, of course, of there being a massive panic and everybody trying to remove all their deposits at once. So yes, there is a risk there. It was designed to cover normal operations, right? We now do things a little bit differently because we have rules. So rather than setting a blanket reserve requirement across all banks, or even doing what the Bank of England used to do, which was to negotiate an individual reserve requirement for each bank, each of the clearing banks. Now what we do is we have what we might call operational liquidity rules that basically forecast ahead expected income and outgoings for the bank, what we call an operational cash flow. And on the basis of that, put in place the funding for all of those payments. And that funding can take the form of actual central bank reserves. And I'll tell you in a minute about what they are and how that relates to central banks. Or it can take the form of things like safe assets of various kinds, such as treasury bills, things that are easily exchanged for reserves in the event of payments, right? And that collection of reserves and safe liquid assets is what we call high quality liquid assets, and they form part of the bank's essential liquidity that they must maintain under the Basel liquidity rules.
So the high quality liquid assets category of like classifying things, level 1, level 2A, level 2B, that like have discounts the further down you go, where I think it's like the bank's own stock is like considered HQLA but with a 50% discount. Is that accurate?
Yeah, we're in the interesting realm of over collateralization and haircuts here now. As a Bitcoiner, you should be familiar with this, right? You know, when in DeFi they talk about over collateralization,
right?
We've been doing that in conventional in banking for millennia. when we talk about when you go out into the market, into the repo market, right, and you want to borrow some reserves, right, or you go to a central bank and you're going to borrow some reserves, right, you're going to pledge some assets, right? Repos are collateralized loans, and central banks want everything collateralized because they don't want to take any losses, right?
Okay.
So you will pledge some assets, right?
Okay.
And your central bank or your repo market or whatever it will be will look at these and say, yeah, these are a little bit risky, these assets, aren't they? So we want more of them than the amount of money we're going to lend you. It's kind of old-fashioned pawnbroking, really. Have you ever been to a pawnbroker's? Right, they'll take your gold and they'll weigh it, right, and then they'll say, we'll lend you this, and the amount they'll lend you will be like kind of 50% of what the gold is actually worth, right? That's over collateralization,
Right.
Like, it's been done for millennia. There is nothing new about this. It's known as a haircut.
So I was confused when I was trying to learn about why the repo markets kind of spiked, the interest rate spiked, and the Federal Reserve stepped in late 2019, I think it was, until mid 2020. They did over $1 trillion, I think, of operations in the repo market over that like 8 months or so, and then got the banks to a over collateralized position with bank reserves and kind of stepped out. Or not, like they just stopped operating so much because the banks had enough reserves, I guess.
Essentially,
but in that window,
they were providing liquidity to the markets, would be a better way of putting it. Right, but I'll talk a little bit about that in a minute. If I can just step back a bit and say what bank reserves are from the central bank's point of view, because I think this is quite important, because we're still in the realm of balance sheets.
Sure.
Right. So
we'll come back to the high quality liquid assets.
It's all part of it. I mean, I've talked a little bit about capital, but at the moment we're really talking about liquidity and payments and how funding markets work and things like the crucial role of high quality liquid assets, not just reserves. Reserves for banks are a specific form of asset. They are specifically deposits at the central bank. Right, that's what we call reserves.
Now, is the terminology sometimes confuses me. Is that central bank reserves or bank reserves, or is it the same
thing?
So when somebody's on Twitter and I'm talking and they're saying bank reserves, they actually are meaning central bank reserves usually?
Same thing.
And so are the bank reserves on the balance sheet, or sorry, like where the bank reserves actually live, the central bank reserves, is that like a database that only the Federal Reserve operates?
Yeah, absolutely. Yeah, if you think about how you work with your bank, right? You have a current account, a checking account at your bank, right? Right. Well, banks have checking accounts at the Federal Reserve or at the central bank, right? Their reserve accounts, or whichever central bank it is, the banks for that. I mean, we could be talking about South Africa, so the Reserve Bank of South Africa. The banks, the South African banks, will have reserve accounts at Reserve Bank of South Africa. Right, and that will contain their cash, their money, the money that they use to make payments between, and all payments to and from banks go to and from other banks.
Oh, so any kind of bank to bank operation, lending or whatever, that is settled through this reserve account.
Absolutely, all payments between banks are settled across a central bank. Every time. If it's a foreign exchange deal, then it'll be settled across more than one central bank, right? But all payments between banks that have reserve accounts, and there are some banks that don't, but we can talk about that separately. But as far as we're concerned, the big banks, the main banks in the world's financial system, all of them settle payments between each other, and that's the vast majority of payments going on in the world, settle across central bank books.
And I think on Twitter you told me that was Fedwire, and then I went back and looked at the history of Fedwire, and it used to be telegrams. That was
I know it's
Morse code.
That's why it's called why it's called Fedwire. Wires. We even call them wire transfers. We haven't used wires since heaven knows since the 19th century or something, but they're still called wire transfers, right? And what we're doing is electronically transmitting money from one bank to another. No, we used to do it by fax. We used to do it by wire. We used to do it by telegram. We used to do it originally by paper in forms of letters of credit. There's always been this way of transferring money, or transferring instructions to pay money, more accurately, between banks. Right now, we do it completely electronically across the books of the central bank using systems called real-time gross settlement systems, which means that they will take the transaction and they actually settle both sides instantaneously. So the money is debited from one bank and credited to the other at the same time. It's simultaneous. And that's, again, because of the magic of double entry accounting, means you make simultaneous postings to both accounts.
So that system then is linked to the commercial banks where the customers have their money and also the central bank accounts. So it settles
Yep.
on both layers of money at once.
Simultaneously, yes. So,
And
and in fact, often, yeah.
sometimes it like probably won't even transfer money from one bank to another. It'll just borrow money from the repo market or something to meet that like touch point of there was bank reserves at some point available to make this transfer, and they'll pay a little fee for that.
No, they'll still. I mean, the money will still the transaction would still settle across the bank's book, the
commercial bank,
central
though,
bank.
right?
Yeah, but the commercial bank might need to borrow reserves in the repo market to have to avoid running an overdraft at the central bank.
Right.
Central banks
Okay.
don't tend to like unauthorized overdrafts very much anymore. I mean, it honestly, it's just like the way you work, right? The central bank is a bank. It has
So
customers.
they go to sleep at 3 a.m. and they wake up at noon?
Actually, yeah, they do.
I'm just kidding.
Central banks are not open all the time.
That's funny. So it does the central bank database, Fedwire, whatever it's called, what is it called? Or is it all kinds of different databases that central bank carries?
Fedwire is the system.
Fedwire
It's the
system
that transfers money. It's the final settlement system. It's a payment system. It's if you like, it's the bottom layer. You've got all sorts of layers on top of that, like Visa and MasterCard and commercial banks and stuff. Yeah, okay. But the bottom layer, the final settlement layer, is Fedwire for the US dollar. That each currency, each major currency, has its own central bank real-time gross settlement system that is the bottom layer and performs final settlement. So for the US, it's Fedwire. I'm not sure what it is for Canada, but what it's called in Canada. But there will be one, and it'll be the
I think
Canadian
it's Bacon Wire.
I don't know. In the UK, it's our system's known as CHAPS.
Okay.
In the EU, it's Target 2. There are these, and they're all the same kind of system. They're all what we call real-time gross settlement systems, and they do final settlement of payments.
So is this system at the central bank level, the database that keeps track of the commercial banks' accounts that they have with
reserve accounts,
the central bank?
They have, yeah.
Does this system also know what's happening in the upper layers? Does it also keep track of customer accounts?
No.
Derivative loans, like all the other layers. So it only keeps
all
track
of the upper layers are held. The records for all of the upper layers are held in those layers.
Gotcha.
The central bank will be completely blind to those. All that it does is handle the movement of money between banks, between its customer banks. That's all it does.
And so in that scenario where there's a base layer of collateral, that's the highest quality collateral, I guess, that banks are willing to use to transfer. It used to be, in the days of like Fedwire, it used to be gold. That was the collateral, right? And then
that was a long time ago. Long before Fedwire existed, really.
So banks would settle between each other with assets like gold, and then when did it become more like U.S. Treasuries as the?
Well, I mean, the Nixon gold shock, really, 1971. Was the watershed when the dollar came off gold. So you wouldn't have got notional movement of gold to settle international payments after that. I mean, you didn't really get movement of gold anywhere. All anybody ever did was change the label.
Not mine anymore.
You kind of push them across the floor of the vaults and put a different label on them. Really. But there hasn't been any movement of gold for payments in the developed world since the dollar came off the gold standard in 1971.
So this concept of how central banks work has not changed in quite a long time. It's just that the nature of the collateral has changed.
The way central banks works fundamentally changed. The whole kind of RTGS, real-time gross settlement system, infrastructure, electronic bank reserves, and all the rest of it, that really dates back to the 1980s. Because prior to that, most transactions were in physical cash. I think people kind of who aren't as old as me have difficulty remembering a time when most transactions were in physical cash. But I grew up in a world where in Britain, when most transactions were in physical cash, people were paid in cash. They bought their shopping in cash. They might have a bank account, but it would be more likely to be a savings account. And it might be in something like a building society, or what in America is known as a thrift. The savings banks were a thing then. Not all that many people had checking accounts. Not very many people had credit cards. There were no debit cards, as I recall. Bank guarantee cards were introduced in the 1970s broadly, and they guaranteed checks, but you couldn't use them as a means of payment in their own right. They really just proved your identity. And so if you wanted to buy something, you either wrote a check or you went to your bank and you had to go to the counter because there were no ATMs. So you actually had to go to the counter during opening hours, which were like 9 till 3 during the week only, and withdraw some cash, and then you could use that to pay for your shopping. And also, most workers were not paid we didn't have automatic payments into bank accounts. Most workers, particularly blue collar workers, were paid in cash on Friday nights. And they went and spent some of it in the pub, and when they came out of the pub, they went home and gave the rest to their wives, who then used that cash during the week to pay for all the household expenses. That's how it worked. And it had worked like that for hundreds of years, really. The watershed was the 1980s, when we had huge changes, and we had the introduction of these final settlement systems for central banks. We also had the introduction of things like what in Britain is known as BACS, but these automatic payments directly into bank accounts, so wage payments into bank accounts. So even managers, no longer being paid by check at the end of the month, would now be paid directly into their bank account. And then with the advent of a much wider, in the 1980s, much more widespread current account adoption in the UK, that was kind of facilitated by free one and credit banking, which encouraged people who didn't have very much money to actually go and put their money into a bank because they would get interest on it. And ATMs, which enabled you to draw cash out when the bank's closed. Checks, identities, and then credit cards, and then debit cards, and the introduction of what we called at the time EFTPOS, and it's still called EFTPOS in Australia, actually. Do you know what that means?
No, what's that?
Electronic point of sale. Electronic funds transfer at point of sale, it means. And we take it for granted now. Everybody uses EFTPOS. We just don't call it that anymore. You go to the supermarket, you pay for your shopping, you do it with a card, or you do it with a phone or a wallet or something. You wave it at the reader and it registers the funds transfer for you, and it's all automated. That was introduced in the 1980s.
Oh, it just took a long time to get adopted.
Not really. Everybody thought this is good, but then we had the introduction of telephone banking, which started at the end of the 1980s. With roughly, we had and we've had the 2000s, really 1990s into the 2000s saw the introduction of online banking. But the watershed really is that big change in the 1980s. That's when so much of commercial banking went online, and importantly, so did central banks. And really, in many respects, it was central banks going so dramatically online with the introduction of real-time gross settlement systems in the 1970s and 1980s that really made it possible for commercial banks to do so as well. It's become a very, very electronic and digital system. America's a bit behind the times on this. Their electronic payments are still pretty long-winded and clunky. I mean, ACH takes a whole day to settle. We in the UK have had instantaneous customer payments since 2007. I can transfer money to somebody else's bank account in a matter of a couple of seconds. And I've been able to do that for over a decade. So we were always a bit bemused when Americans say, oh, well, in the wonderful cryptocurrency world, everybody will be able to sort of buy a coffee instantaneously. And we're going, well, we've been able to do that for a decade. Where have you been?
We've in Canada, our system is it feels a little bit backwards. We have email money transfers.
Oh,
I don't know
right.
if you have those in the UK.
Well,
so it's basically like you register with your bank, your email address, and then you can use your online banking account to send email money transfers back and forth to people. And
Right.
there's not that many banks in Canada, so like they all have this Interac
Yeah.
email money transfer system. It's kind of clumsy, but a lot of people use it, and it settles really quickly. The limit is like $350 or something like that, so it's pretty
All
low
right.
limit. And I think $3,000 a week is like the limit. So it's not useful for like making big payments or running a business or anything, but for just paying people, it's not near as good as like the challenger bank sort of apps that the US has, where you can do like
Sure.
Cash App or
The Venmo
Revolut
and
or
things, but then
Venmo. Yeah.
but it depends where you are in the world. You see, America has the challenger bank, things like Venmo, precisely because its banking system is really quite clunky.
Yeah.
It's kind of behind the times and clunky and slow and expensive and all these things, and it's totally legitimate to say so. When you think the Fed is only discussing having a faster payments application now, and only in response to things like Venmo, and I just think this is really sad. Um, no, whereas when you come to Europe, things are very different. It depends where you are in Europe as well. In Germany, they like their cash. But if you go over the border into Denmark, you find nobody uses cash. They're using instantaneous payments all the time and for everything. It's not email money, this, by the way. It's often mobile phone based. And
Right.
and
Okay.
underneath it is a bank, but the banks all have phone apps. My bank has
Oh, that's
phone
cool.
apps. I
Yeah,
I do all my payments with my phone app from my bank.
we can do some activity on the phone app, but it's not as, I mean, this, it should be way better for sure. It should be way
Mm.
better. But like going back, so I was trying to think of like how banking has changed throughout the last 100 years or so, and it seems like it started as gold was the collateral that was used to settle between banks, and central banks, and then it shifted to U.S. cash and U.S. treasuries and physical cash. So physical U.S. physical cash, to settle bank to bank. And
I think we need to be a little careful in what we mean by collateral here. Can we talk about cash? Because when you're settling a payment, you're not using collateral, you're using money. And
okay,
money, a settlement between banks for hundreds of years has always been some form of money. It's not
right,
collateral. Collateral is security. It's a physical.
sure,
It's
yeah, I
an asset
misused
that
that
you.
word.
Yeah. We
Yeah.
need to be careful about terminology here. Um,
So the
uh,
the settlement asset, I
mm.
guess, was gold, and then it shift to physical
Well,
cash, or did it shift to
actually,
treasuries?
if I can pick you up on that, I think we need to
Sure.
distinguish between domestic and international payments here. The settlement asset for international payments was gold, and for a very long time. And the reason for that was that if you think about it, countries have got different currencies, and different currencies currencies have different exchange rates. So gold is like a universal settlement asset, and that's what a gold standard is. It creates a universal settlement asset that anybody can use wherever they are in the world. That was the brilliance, really, of the classical gold standard, and it's what Bretton Woods, the post-World War II gold standard, tried to achieve. It tried to achieve it by linking only the US dollar to gold and everything else to the US dollar. So actually, the rest of the world wasn't really settling in gold. They were settling in US dollars, which were pegged to gold.
After
And the
Bretton Woods,
only
right?
point, that was Bretton Woods, yeah. And the
Which
only
was
point,
50s.
yeah, 50s and
Okay.
60s. It ended in 1971. So
So
what
so
uh,
gold, then U.S. dollars, physical
everybody was
U.S.
using the
dollars.
US dollar, and they were using the US dollar because the US dollar was hard pegged to gold,
Right.
right, which gave it its value. And the point at which gold started to become important was when the ability of the US dollar to hold its peg to gold became uncertain, which was towards the end of the 1960s. And
Mm.
so we ended up with that unedifying spectacle when Nixon suspended the gold standard in 1971, of the French threatening to send gunboats across the Atlantic to come and claim their share of the gold reserves in Fort Knox, because they regarded the suspension of the gold standard and the devaluation of the dollar as a default
Mm-hmm.
on the US's international obligations, which ultimately were payable in gold.
Right.
It's still arguable that that was a default.
So at that point, after 1971, when the U.S. went off the
Yeah.
gold standard, then did it. How long did it take? You said the 80s, I suppose, was when it shifted to digital
Yeah,
U.S.
really.
dollars as the
Yeah,
settlement medium.
although, for there've always been wire transfers, really. It's not that we were shipping kind of, tons of paper around, because we weren't. We were sending wire transfers.
Oh, so
It
even during the Bretton Woods era of like the 50s and 60s and
Yeah, for large payments,
70s.
so you're using wire transfers. Absolutely. We
Okay.
had telegrams, we had faxes, that's what we used. And
So it
we
was just
started
like
using,
how
yeah.
would it be accounted on the Fedwire system or the central bank's books if they weren't
Well, if
actually
you think
settling with
about an
physical
accounting
cash?
system, I mean, you go back to the Victorian era, right, the 19th century, they were sending instructions to make payments by wire, right,
Hmm.
by telegram, right? But then some clock in the central, in a back office somewhere, and they might do it directly between banks without involving the central bank, by the way, because
Okay.
the settling everything across the books of the central bank kind of happen later. But if you sent a wire, if one bank sent a wire to another bank saying, please pay this person this much money, then some clock in a dusty back office at the receiving bank would sit there with a ledgers and a quill pen and actually write the entries in according to the instructions he'd received by telegram. Got it?
Right.
Because ultimately money is a movement, is a ledger movement, right? So if
So
I
in
pay,
that olden scenario, right? Was there eventually like there was a ledger that kept the balances, but was there actually settlement at some point that had to happen with something physical like gold or whatnot?
well, there's no only only to the extent that your banks had to stay solvent, really.
Okay.
and to the extent that your customers were withdrawing their money from the banks, right? If you think about it,
Right.
as long as banks are just making payments between each other, right, and it's all done by telegram and clerks in dusty back rooms writing things out with quill pens, then one bank might be receiving some money and another bank might be sending some money, and one bank kind of might have run out of money relative to the other one, but it doesn't really matter because it's all in the ledger, isn't it? It's only really if the customers come along and say, right, now can you give me some greenbacks?
Yeah.
Yeah.
And
Then they run it.
that's when the
Yeah.
bank run happens, or when the confidence is shaken that maybe this bank doesn't have the money,
Yeah,
so people go and take it out, and then if they are
that's
insolvent,
right.
they fail.
Exactly. And of course, in the days when most people were working in cash, so we're talking about the real economy now, most people, most households, most businesses were working in cash, in physical cash, right? Then whether a bank had actual physical cash mattered. And if they didn't, then they had to go and get it.
Hmm.
You see, and that time by horse and cart. It was like
Right.
actually getting the reserves you needed to pay your customers was a bit of a problem. Now you can do it instantaneously, right? You can go out into a repo market and get a loan instantaneously, just pledge an asset. But in the olden days, and in some developing countries now too, developing countries where going out into money markets and getting loans isn't that easy, right? It's still not that. It's still like that. They still have to kind of get physical money in by horse and cart.
Hmm. Yeah, that's so I guess it's really like two different conversations, like how the money works. There's the conversation about like how, like, from I guess a practical point of deploying a money to the citizens and using the
Mm.
currency, and like how to most efficiently um, make that money work without friction in the economy. And then the other conversation is about like what Bitcoiners and gold people always talk about, which is like the act of lending out so much money, which will devalue the money over time, which is like
Mm.
theft of people's savings, and
Yeah.
keeping the interest rates artificially low too long encourages too much risk, which can then balloon up. And then that they're really two separate conversations. They're kind of
Totally.
linked,
Yeah.
but I mean, you don't have to go into that to just it's very hard to understand how money actually works. Like it's very complicated.
Yeah.
And I don't think there's anything wrong with asking questions, you
Not
know.
at all. I mean, I think sometimes, but it is helpful actually to kind of go back to kind of how do people actually use money, and how does what we do now, the way things work in the developed world now, differ from the way things worked in the developed world 50 years ago and the way things work in developing countries now. Many developing countries, it's still physical cash. You go to Mexico, 60% of transactions are in physical cash. Most people, and a lot of people don't have bank accounts, right? It's very, very different.
Do you think that, I mean, with the increase of efficiency with the digital money, do you think that if you had to like print the cash, if you have to print $10 trillion and deliver that to banks and to the citizens in the United States, that would take a long time and a massive effort to actually physically print that much money. But because of the shift to digital money, it's just it's a button and an entry in a database.
It's so much easier. Yeah.
Is it actually kind of, how do you think that's going to play out, that we're able to like use this new technology to I mean, we've seen the money stock supply go up a lot in the last 10 years. I know that your views on quantitative easing are that, and tell me if I'm misunderstanding, but the way that I've understood it from like kind of like reading your summaries of the book and like talking to you on Twitter and stuff, is that quantitative easing in a way is the only appropriate solution to prevent a collapse in the economy when the liquidity locks up between banks. So they should do quantitative easing, but they should also give money to the people so that the people can feel like it's not unfair.
It's not quite that. Not
okay.
My view is a little more kind of nuanced than that. If I can talk through, there's a few things. If I can unpack that a bit, because you've mentioned this before about what happened in 2019 with the liquidity freeze in repo markets. Actually, what happened then is actually really quite important, because that kind of sets the scene for a lot of stuff that's happened since. When I mean, central banks have been doing QE since non-stop since 2008, and in fact, there was quite a lot of QE that went on before 2008, notably by the Bank of Japan, which has been doing it since about 1995, off and on.
Did they call it quantitative easing, or was it
no? No, but that's what it was.
Doing it.
Yeah, they were doing it. In fact, later on, they did call it that too.
Is it like, technically, is it considered both keeping the interest rates low and buying things, like central bank buying things from the banks, or like what's the technical definition?
Okay, let me talk through the macroeconomics a little bit here, because really that's what you're saying the other conversation is. QE is a macroeconomic tool. It's intended to influence the economy. But there are very similar tools are used to influence liquidity in markets as well, and sometimes those two get confused. But there are two distinct things there. They are kind of the same tool used for different purposes, if you like. Right. So what happened in September 2019 was a liquidity problem in the markets. And it's quite technical what happened there. But if I can summarize it, the repo market, the US dollar repo market has become very dependent upon four big banks lending excess cash, which they have because of the excess money created by QE, lending that into the market. And the whole market has become dependent on that, right? The Fed had been withdrawing reserves from circulation over the previous 2 years. Again, Bitcoin is, honestly, they act as if they don't know this. But dollar QE, US dollar QE, ended in 2014-15, and then in 2017 and 2018 the Fed was actually reducing its balance sheet. It was withdrawing reserves from circulation.
And how does it do that?
And what Bitcoin is called burning them.
So is that where it actually just deletes entries from the balance sheet, like of base money?
Not quite. It's more to do with balances. So QE, as we understand it, the main form of QE is what we call large-scale asset purchases, where the Fed goes out into the market, or whichever central bank it is, goes out into the market and buys lots of financial assets, usually, but not exclusively, its own government's debt, right? Some central banks buy other things. The Fed buys agency MBS and also the coupons of agency MBS as well, which are not government debt, but they are regarded as equivalent to government debt because they're issued by government-sponsored enterprises, Fannie Mae and Freddie Mac.
Is
Right?
that the part of the high quality liquid assets definition where those would be like level 1 assets?
But yeah, they are. Yeah, absolutely. Yeah, they are. But
Okay.
here we're talking about the central bank,
The
not
central
about the
bank.
commercial banks, but those do form part of high quality liquid assets as held by commercial banks as well. That's why central banks buy them, is because they're safe. They're not buying risky assets, they're buying safe assets. I've seen this said so many times that central banks buy toxic assets from bank balance sheets. No, they don't. The central banks never touched those. It was the governments that bought them.
So governments can how does the government buy them? Like the Treasury buys it directly, or?
Yeah, except they didn't. They were going to, in the TARP
Okay.
program in the US, they were
Okay.
going to actually buy the toxic assets off the bank balance sheets. But in the end, they discovered it was easier just to give the banks some money, really, recapitalize them, and leave them with the toxic assets, but give them a bit more money.
The mortgage-backed securities, is it fair to consider that level 1 if we had the
agency
2008
ones?
financial
They
collapse?
are prime agency MBS. They are not the kind of MBS that went wrong in 2008. Those were issued by investment banks, and they were subprime.
What's the difference between that,
Okay.
the mortgage-backed securities that kind of caused the collapse in 2008 and
Okay.
the agency ones?
There's a huge difference. Mortgage-backed securities that are issued by the American government, the US government-sponsored agencies, Fannie Mae and Freddie Mac, and there's also Ginnie Mae as well, which wasn't involved in the financial crisis. They are implicitly backed by the US government. They're regarded as equivalent to US government debt. They have the same kind of federal guarantee. They're guaranteed by the Federal Housing Association. They're not going to default. That's very different from the subprime mortgages that were pooled and tranched and securitized by investment banks. They didn't have that guarantee, and they didn't have the quality checks either. There was a huge fraud in underwriting. The underwriting standards were terrible, and so actually they were just much more risky than the investment banks had been letting on, or that the credit agencies had been letting on. There was a whole industry. There was a whole industry in.
How do you even trust any of this stuff if it came out that there was so much rampant fraud from the credit agencies and the big banks?
Absolutely, there was a whole industry in manufacturing things that were supposedly safe but actually weren't. Right, it's one of the biggest, for my money, it's one of the biggest frauds in history. But it actually didn't concern. I know that Fannie Mae and Freddie Mac had to be bailed out in the financial crisis.
Yeah, that was the
they got involved in a few things that they shouldn't have done.
But they're the ones issuing these MBS, and they had to be socialized.
But they weren't issuing those MBS. They owned some of them, but they weren't issuing them.
So they weren't the ones that were issuing the toxic stuff. They were just participating in the market and didn't know that they were participating with toxic stuff.
It's a little bit more complicated than that. But basically, the prime MBS that Fannie Mae and Freddie Mac issue are still regarded as primary safe assets, and they're bought by the Fed. And the Fed also
What are those made up of? Are those like government buildings or something? Like what is the?
No, they're households. They're household mortgages, but they're good quality ones.
I guess.
Mortgages. No, they'll be just ordinary people.
Okay.
Ordinary householders, but excuse me, get a glass of water.
Yeah, no problem.
No, they'll just be ordinary Americans with their primary residence and their gold-plated 30-year fixed rate mortgage. Right, it's those which at a loan to value of 70% or something.
Okay, so it's pretty safe unless.
Good quality, safe mortgages that are not going to default.
Unless the bubble pops in the housing market, but even then, you think that if the bubble pops in the housing market,
because they do have a federal guarantee, so they're safe anyway.
Okay, so it's not like a lot of higher valued mortgages in bubble cities and stuff like that.
Exactly, it's very different.
Okay.
So those are mortgage-backed securities, but not the subprime ones that went wrong in the financial crisis. Those kind of broadly don't exist anymore, really.
Okay.
because their value crashed to zero, and their derivatives, and the value of those crashed to zero, and they haven't really resurrected much.
So you're saying the central bank will through quantitative easing will go out and
buy lots of those.
agency
If they buy,
MBSs
agency
and treasuries.
MBS treasuries. Some central banks buy corporate debt. The UK central bank did twice, once in 2016, and again in 2020 it bought corporate debt, but they're blue chip corporates.
Didn't the Fed end up buying some bonds as well in 2020?
Yeah, I think it probably did. And the Japanese central bank has bought some equities. Right. In theory, a central bank could buy anything, but they do have an eye to the fact that backing them is taxpayers, and they have a duty to taxpayers. So they're not going to take on just anything. They focus their purchases at the safe end of the asset spectrum, if you like. They're not going to start buying junk bonds. At least, I suppose, if they were totally desperate, they would. But they'll kill off the safe assets, the blue chip assets first, because they want to keep their own risks down. But that's what we think of as QE is these large scale asset purchases. And notice I said large scale; they buy enormous quantities of them. Right. So in 2017 and 2018, there are two ways of reducing, of getting rid of the asset purchases, right? The bonds that they've got on their balance sheets. One is to sell them. Another is to lend them out. And a third is simply to let them mature. And in 2017 to 18, the Fed let a lot of the bonds on its the assets on its balance sheet mature. Is
that what they say when they say rolling off the balance sheet? Is that what they mean?
That's exactly what it means.
So the Fed was rolling off its balance sheet, letting things mature. And
letting
what happens
things mature
when it matures?
Now, when the Fed buys assets, it creates new bank reserves. Okay. It's exactly the same as it is when banks lend. So remember I explained earlier that when a bank lends, it creates a loan asset and it also creates a new deposit. They do that when they buy assets as well. Banks do. And central banks do as well. So when they buy a financial asset like a US Treasury, right, they're going to create a new deposit. And they'll use that deposit to pay for the thing they're buying.
Is this a central bank reserve deposit or a commercial bank like money deposit?
It's the same thing. There's a central bank reserve account. It's exactly the same. The central bank, if it's buying an asset off a bank, and a lot of QE purchases aren't from banks, but let's not complicate things. If a central bank is buying, say, US Treasuries off a bank, right, it will accept those US Treasuries onto its own balance sheet, and it will put money reserves into the commercial bank's reserve account.
So it confuses me because I have a lot of people I hear talking about this now are saying that that's not really money. They're saying that the central bank reserves shouldn't be looked at as money. They should just be looked at as collateral that will never make it.
No, they're not collateral. They're not collateral. We must stop misusing that term. They are money as far as the banks are concerned, right?
That's the way I think about it, but I keep hearing people tell me not to think about it as money, and it's confusing me because I'm like, but it's money, isn't it?
Monetary economists call it high-powered money. They absolutely call it money.
James replied in a tweet saying that it could actually also be transferred to the commercial banks or physical cash if they request the money.
It could be paid in the form of physical cash, absolutely. So if the central bank bought some US Treasuries from a bank, and the bank said, actually, I need some money for my ATMs, so could you please send me that in physical cash? It would do so. And it could pay for the treasuries that way.
Now, right? Like around 4 trillion of this type of money that's central banks.
And nearly all of it is in the form of electronic money, not physical currency. We have had rising quantities of physical currency, and I think for various reasons that aren't entirely clear, it does seem to, some people do seem to have sort of gone for a preference of holding physical cash, which I think is to do as a general reflection of feeling uncertain and unsafe, and therefore wanting to stuff their mattresses. But the vast majority of central bank money now is in the form of electronic money. The bank reserves that are the liabilities of central banks and held in reserve accounts belonging to commercial banks. Okay, that's the majority of central bank.
The people that like and it's funny, it's not just Fed defenders or whatever. It's also Bitcoiners that are I've been saying this to me, that like that's not real money, that's actually trapped inside of the Federal Reserve reverse repo system, so it's never going to make it out to the wider money economy.
Okay,
so
well,
don't
that is
think about
also
it as
my
much.
argument regarding people's QE, that the problem, if your approach to trying to reflate the economy is that you're going to give money to banks and then kind of hope they magically do something, kind of fails if your banks don't want to do that. And what we saw after the financial crisis was, and this was kind of where even central bankers didn't understand how QE worked and the crucial dependence on banks being willing to lend, was that they thought that giving all this, that buying assets off banks, and therefore, as a result, in effect, giving banks lots more money. So exchanging parts, if you can think of it as like if banks have got assets on their balance sheet that are illiquid and not very useful, the central bank can buy those and replace it with cash, and then banks have got a lot more cash, so they can lend that cash out, can't they? And they honestly thought that's how it would work. They honestly thought that's what QE would do. Would give banks lots more money, and then banks would lend that money out, and that would get into the real economy, and people would borrow that money and refurbish their houses and invest in new businesses, and there'd be a huge improvement in entrepreneurship and business investment and spending and lots more employment, and it would work that way, right? And you will still see that argument used, particularly by the Fed and also by the ECB. Both of them are still saying that the bank lending channel is important. The Bank of England, right from the start, which I mean, the UK was more badly hit, really. The UK's banking sector was more badly hit than any other country in the financial crisis, with the exception of Ireland and Iceland. And the UK was also the home of the biggest bank that failed in the financial crisis.
What was that bank?
RBS. It was the third bank in the world by assets at the time.
Okay.
Yeah. And it's one of our four major clearing banks, and it's near failure. We were within half an hour of losing our ATM network.
Wow.
It would have brought down the whole system. So maybe the UK's mind was, the Bank of England's mind was a little bit more concentrated on the parlor state of the banking sector. But they concluded right from the start. It's very interesting reading the MPC minutes from when they started QE in March 2009. They concluded the banks were so weak that just giving them additional bank reserves was not going to encourage them to lend. They had to sort their balance sheets out. They needed more capital. They needed to de-risk their balance sheets. They needed all sorts of stuff, and they were not going to lend. So right from the start, the Bank of England said, we have to do it a different way. And what they did was they bought assets directly from the market. Now, the effect of that is still to increase bank reserves, because all purchases from markets go through banks. So the way it worked was that the commercial banks bought the assets from the markets and then sold them on to the to the Bank of England, if that makes sense. That is actually how it works.
They would instruct the banks to buy from their clients, and then they would trade.
Then they would buy from them. Yeah, absolutely. Yeah. So and then when that happens, you obviously have an increase in reserves for the bank, but you also have an increase in bank deposits for the bank's customers, because they ultimately are the people that the central bank has bought the assets from. And that money stood a better chance of getting out into the real economy. It would at least get into financial markets reliably. But the problem is that if a central bank is buying financial assets like treasuries and whatever, then the holders of those assets are going to be mostly institutions like pension funds, and they might be high net worth individuals, rich people, right? So the money was all going to, one way or another, people who were going to save it, right? It's not going to people or companies who are going to spend it in a way that was going to increase investment, employment, spending. There was some effect. There's some evidence that QE did raise employment gradually over time, but the downside is that is you had to do an awful lot of it, and an awful lot of it got saved. So my argument was that I thought this was a bad idea. I thought the money should have gone directly to households. Particularly, I thought that the early decision by the US Treasury not to bail out householders after the financial crisis was a very bad one. I think they paid a heavy price for that in lots of ways, both economically and politically.
Yeah. But even still, Steve Mnuchin got a nice job at the Treasury after taking over that what was it, that investment bank that ended up kicking people out of their homes. And
yeah, no, it doesn't bear thinking about it. We don't seem to have sort of understand what the purpose of government is. No, ultimately the purpose of government is the business of government is the well-being of citizens. And if you're spending all your time propping up financial markets and your citizens are getting into deeply into debt and struggling to pay their bills, then you're kind of failing as a government, really.
So quantitative easing, then, if you're to argue for quantitative easing, it's to prevent collapse of not necessarily full collapse of the system, but to prevent a recession.
Yeah. What they were trying to stop was a 1930s style depression. So if you sort of rebound back to the 1929 Wall Street crash, we had this disastrous collapse in asset prices. When asset prices collapse like that, an awful lot of people lose their savings. Because assets, they are people's savings. Even if they're owned by pension funds, they're still people's savings. And so you've got an awful lot of people who, if you allow asset prices to collapse, an awful lot of people who lose their savings. And when people lose their savings, they well, lots of them lose their jobs as well, and businesses lose their business assets collapse, businesses lose their jobs, people stop spending, all sorts of things go wrong. So what they were fundamentally trying to stop was this disastrous collapse in asset prices that this financial crisis had kicked off.
They succeeded at that.
Yeah, they did. And I say in my book that QE1 worked. The first QE done by central banks around the world, and particularly by the Fed, worked. It did stop the collapse of asset prices. It did. It was effective, and I think that actually was one of the main reasons why we didn't have a 1930s style depression. The only place really that did have a 1930s style depression was Greece, and that was cut out from ECB QE, and also it has had severe fiscal austerity. Now, I think where I've said where we went wrong was that first round of QE was supported also by coordinated fiscal stimulus by countries around the world, as indeed the QE in 2020 was as well. And for the same reason, it's been pretty effective. We had a deep recession, but we've rebounded ever so fast from it. And I'm not sure that would have been the case if we hadn't had that combined QE and fiscal stimulus. Where I take issue with central banks was then subsequent to that, when we had 10 years of fiscal austerity, with central banks continuing to do QE to try and keep the show on the road, because fiscal austerity in weak and damaged economies where banks aren't working properly is a recipe for depression. We had this kind of long-running stagnation and yards of QE all the time, just to try and stop it actually becoming a depression, if you see what I mean. And I don't think that was sensible policy, and I've been saying so for 10 years now, and I think the world is beginning to come around to my way of thinking, that we shouldn't have done it this way.
If the idea of fractional reserve banking is not like a good way to think about modern banking, in that you need to have like seeds of money or whatever where you can then sprout more money trees, um, with the collateral you're getting from deposits or whatever.
Not collateral. Please don't use that term.
Well, okay, so in the idea that, like, let's say fractional reserve banking was real and that's the way the money system worked, wouldn't you have collateral if someone deposits money into your bank?
No, it's still a misuse of the term collateral.
Oh, okay. So what would
Collateral
that be?
is
Equity?
right. Okay.
Assets?
Deposits in a bank are loans to the bank. They are the bank's liabilities. They are, if you like, debts. The bank owes that money to you. Right? Does that make okay?
Yep.
It's not collateral. It's not collateral. It is simply the liabilities of the bank.
So in the concept of fractional reserve banking, how does it start and how does the money multiplier?
The money multiplier doesn't work and hasn't done since the advent of QE. I question whether it ever really existed in the form that it's described in the textbooks. There is and always has been an arithmetic relationship between the quantity of reserves on a bank balance sheet and the quantity of loans it can do, but that's kind of an ex post relationship, and it's to do with the reserve requirements if you have one. So remember I said that the reserve requirement is 10% for the US reserve was 10% of eligible deposits. Now, obviously, if because in the course of lending you create deposits, obviously, if your reserve requirement is 10% of your deposits, when you create a loan, you've got to increase your reserves, haven't you? Can you see that?
Well, that's what I would assume, but then I learned that they don't really need to increase the reserves. They just need to borrow them temporarily to
they borrow them. Yeah, absolutely.
But it's
then
not
the whole
actually
world,
like increasing it on their balance sheet. It's just like
it's
a
still
repo
if you borrow.
loan.
Well, yeah, but look at it this way. It's back to our friend the double entry again. If you borrow something, say I borrow some money from you, right?
Mm-hmm.
I have a liability to you because I owe that money. But I also have an asset because I've now got money that I didn't have.
Oh, so the way I was thinking about it was that it worked kind of like the way that shorting a stock works, where you have to locate the share in order to short the share. And once there's a locate, the share doesn't actually move. It's just you've located it, it exists, you can short. I figured that was the same way with commercial banks, that they can make loans, but they don't actually need to like borrow it for good. They just need to like do it overnight, pay the interest on the overnight borrow, settle it up, and then still the money hasn't moved, like the collateral or whatever that they're borrowing hasn't moved.
It's not collateral. I really want to get away from this idea of collateral.
So in the repo markets, is that not?
The repo market is collateralized. But let's talk about unsecured borrowing, because the original interbank market, which still exists, right, although it's used much less these days, but prior to 2008, banks didn't use the repo market much. They borrowed reserves off each other in the interbank market, and that's unsecured. There's no collateral, right? So if a bank was short of reserves, and you can talk of short and long, okay, because it's if that's a terminology that helps you, because you could say, the banking system collectively has to hold all the reserves that a central bank produces, all of them without exception. The only form of central bank money, which central bank money, base money, is made up of bank reserves and physical currency. And the only form of central bank money that the banking system doesn't have to hold is physical currency. The banking system actually even holds quite a lot of physical currency because it's got to fill its ATMs, right? Okay. But the only form of central bank money that gets out into people's pockets is physical currency. Okay. The rest of it, and like I said, it's most of it now, but prior to 2008, it was only a small amount. Most central bank money was physical currency. The quantity of central bank of electronic reserves in circulation was much, much lower before 2008. But the banking system, banks collectively have to hold all of the electronic reserves that are produced by the central bank. They have no choice about that. But how many of those reserves each one of those banks holds depends upon the movement of money between the banks. Can you see that? And that in turn depends upon the pattern of payments by bank customers.
Right.
So
That's
bank.
That's the LCR in Basel.
No. The liquidity. That's the liquidity coverage ratio. We'll come on to that in a minute. Let's just talk about the movement. I keep coming back to payments here.
Sure.
So reserves, when a bank makes a payment on behalf of a customer, right? Say, you pay me some money, you send me some money via your bank to me, then your bank will settle in reserves, right? So it will lose some reserves and my bank will gain some reserves, right? And it will then, my bank will then put an equivalent amount to the reserves it's gained into my deposit account, right? Reserves are an asset for the bank and a liability.
This is the part where I think I have some confusion then, because I understand that that's how it's supposed to work and that's how it should be accounted for. But then I also thought that the way that it's actually practically happening is that my bank does not actually have the bank reserves, so they're going to go to the repo market, do a quick borrow of somebody else's reserves, and then settle the trade to your bank.
Can I come on to that? No.
Sure.
That's
not how it works?
Right. So if I can finish the story, right. Yep. Now, supposing your bank doesn't have enough reserves to settle the transfer that you want to make to me, right? So the bank will have to go into the interbank market, and I'm being careful here not to use the repo market because the repo market is collateralized. Interbank is unsecured. It could go into the interbank market, and prior to 2008, this is what it would have done: gone into the interbank market and borrowed reserves off another bank. Right now, when you borrow
temporarily or a long time,
temporarily, usually overnight.
An overnight, right?
Yeah. But
and they pay a small fee, like
they'll pay some interest
points or something.
Yeah, they'll pay some interest. LIBOR, actually.
Okay.
That's what the LIBOR rate was. Was the rate was
London
the interbank lending? That's what it means. London interbank overnight rate.
So when it was higher, when it was like 5%, was it ever that high? It must have been.
It was.
So absolutely. When it was that high,
in the 1980s, it was higher than that.
Right. So in that scenario where the interest rate to go out and borrow to meet that requirement to transfer reserves, in a high interest rate paradigm, there's actual risk there, and it actually costs banks money to operate with extremely low reserves because they actually have to pay quite a bit to go and borrow the reserve.
They do
to settle with, right? But in a low interest rate environment, they can just keep making tons of loans, and it's not really a big deal because they can just keep borrowing.
Well, it's not really like that because it's bid and offer rates. Do you know the difference in a bid and an offer rate? Remember I said right at the beginning that banks earn their profits on the difference between the interest they charge on loans and the interest they pay on deposits. Now, the same is true with wholesale funding, interbank funding or repo market funding. It's exactly the same, that they're paying an interest rate, which these days is not very much, but back in the day was 5% or more, depending on how whatever LIBOR was.
Right.
On their wholesale funding, and then they're going to be charging a margin over that on the loans, and that margin is their profits. And banks always work like that. So if your LIBOR is 5%, then your margin on your loan on an average mortgage is probably going to be about your average mortgage is probably going to be about 7.5%. But so the bank is getting interest margin of 2.5%.
So
do you see what I mean?
Yeah, but to me that's two separate conversations. To me that's profitability. Like
it's fundamental to what banks do. That spread, you have to think in terms of spread.
The bank will in that environment of high interest rates, the bank, of course, is going to charge a high interest rate for their loans so
Yep.
that they will have profits. They will be willing to pay the LIBOR that's high because
Yep.
they have higher spread. They have a spread that's makes sense for them. The customers are willing to pay 7%. They pay a quick 5%. It's still
It's
they're
still
making
worth
a
their while.
profit.
Exactly.
But the thing that I'm getting to is that the behavior that a bank will take in a low interest rate regime where it's pretty much zero seems to be like encouraging higher risk because they don't have to
Well,
keep collateral or
no,
whatever
not collateral. Please don't
reserves.
talk about collateral.
So
We are not in the realms of collateral here.
is reserves not considered collateral?
No,
Bank reserves?
no,
It's not. Oh,
no.
okay.
No,
So
bank reserves are not collateral. Banks need collateral these days. Banks need collateral in order to borrow reserves. That was not the case before 2008. They could borrow unsecured in the interbank market
I gotcha.
at
But
LIBOR,
oh, okay. So
at LIBOR or more.
in the repo system or even reverse repo, I guess. Well, no. In repo, in the repo system, bank reserves are not counted as HQLA?
HQLA include bank reserves, but HQLA are not just collateral. If I can explain what I mean, HQLA collectively, bank reserves and other liquid assets, and together collectively they make up the bank's liquid assets that are required to meet its LCR. Right.
Okay.
The idea being that you're either holding the actual reserves that you need to make the payments, or you are holding something that can be quickly and easily exchanged for those reserves. Now, in a way, by talking about repos, muddying the waters slightly because repos are accounted for as collateralized loans. So I want to talk about them slightly differently, if I may, just for a minute. This is a little bit illegal, what I'm going to do, but it will hopefully get the point. Imagine that I need to that I need some money overnight, right? And I've got some gold. What I could do instead of lending that gold is I could sell it to you with a forward agreement that you'll sell it back to me tomorrow.
Okay.
Right, that's a repo.
Okay, so that's not actually collateral then in that?
It's accounted for as a collateralized loan. But it's actually a spot and forward, a spot sale and a forward purchase of the securities. Okay, does that help to think of it like that? We aren't allowed to account for it like that. In fact, well, no, we are allowed to account for it like that if we recognize the forward purchase. Right. Lehman accounted for repos like that, but it only recorded the spot sale and forgot about the forward purchase. Well, ignored the forward purchase, and that is illegal. If you look up Lehman 105, that's what they were doing, and that's actually illegal because they were only accounting for half the transaction.
So it's like kind of a different structure of a transaction. It's not actually like a collateralized loan. It's actually a sale and a purchase.
Well, yeah, except you can think of it. You can think a spot sale and forward purchase of securities is equivalent to a collateralized loan.
Okay,
if
but
you think about
in the interbank markets, that's not how it's structured. It's just borrowing.
We would account in the interbank markets. They should be accounted for as collateralized loans, and this goes way back to the 1980s. I was doing repos then, and we were accounting for them as loans. As collateralized loans, and it affects how they're handled, how they're handled from an accounting point of view. It doesn't change their nature in terms of funding. If what you're trying to do is fund something, it doesn't make any difference whether you sell your auntie's gold ring today with an agreement to purchase it back tomorrow, or whether you borrow some money against it as collateral with the promise to return the money tomorrow.
Mm.
It's functionally the same thing. Can you see that? Pawnbroking, yeah.
Okay, so
It's all pawnbroking.
can I run you through my thought process on the run up to the latest sort of coronavirus stimulus, and you tell
Of
me
course.
where I'm not thinking about it right?
Okay,
Because
go ahead.
I think I've misunderstood a few things, but I mean, I've tried to look into this, and I've tried to go and like read about Basel Accords and high quality liquid assets and bank reserves and all this stuff,
I know,
and
and
it
it does your
seems
head in, doesn't it?
it's so complex. It's been like 2 years I've been trying to still like
Oh
every
goodness.
couple of weeks I'll go back to it and I'll be, all right, I'm gonna take another stab at this. It's so complicated. And then I learn about something and then I meet somebody like you or James and they're like, actually that doesn't exist. And I'm like, what did I just read about? And like Bitcoiners too are like, yeah, you don't understand how that works. That's not how that works. So it's so
Oh
complicated
goodness.
to understand collateral and money and high quality liquid assets and all
Sure.
this stuff. But this is the way that, I mean, it feels like something is wrong with the banking system. As a normal person that grew up in not going to study economics or anything like that, seeing the value of money continue to drop, seeing the price of things rise all the time,
Mm.
it just feels wrong that the dollars keep going down in value while banks and corporations keep getting bailed out. So maybe I come at it from a naive perspective or something of how the money system actually works, but it just feels off. It feels wrong. So I guess I'm always trying to look for like, where's the scam? Like where are they scamming us?
That's understandable.
So here's what I was thinking that happened, and I, I looked. So starting, I guess, from when 2008, or I guess when LTCM almost brought down the financial system in the late 90s or early 2000s.
Yeah, so that was much longer ago. Yeah. Okay.
Yeah. So just from I read about that, and the way that I understood that to work was LTCM was doing this statistical arbitrage play on government bond trading,
Mm-hmm.
and they were kind of arbing the difference between the longer dated stuff and the shorter dated stuff, and
Yeah.
they were betting that they would meet, and that
Yeah.
people that were issuing, there was like an arbitrage there that they could use like these algorithms to trade and print tons of money using leverage on these bonds.
Yeah.
And it was very safe for a long time. They were like the smartest people in the room, and then something happened where like a lot of banks had exposure to LTCM's products, and it was considered very safe. And then Russia defaulted on their debt, and it blew up the whole thing. And then that was a liquidity crisis because banks no longer knew who was holding LTCM stuff as collateral or as assets or reserves or whatever.
Much like Lehman in that respect.
Right. And then the Federal Reserve and the big banks got together and kind of had a meeting about it and said, like, this is going to cascade to the rest of the banks because everybody's exposed to these guys. So we have to, like, I think it was Bear Stearns or somebody
It's always Bear
called
Stearns,
in
isn't
their
it?
debt. they wanted, like, they did a capital call or whatever where they
Good old
wanted
Bear
their money
Stearns.
back. And so the Fed, I don't think, stepped in at that point, right? They kind of worked with the banks and helped the banks, kind of like the big banks sorted that out. LTCM failed.
Yes,
But it didn't cascade to the rest of the banking system.
No.
As far as I understand.
There have been other examples of central banks stepping in to provide liquidity to banking systems which are under stress. I mean, the earliest one, I mean, even you to go back to like 1906 to find, JPM leading a consortium of banks to provide to bail out the markets then when the Knickerbocker Trust went down. I mean, how far back do you want to go?
Right.
Within my lifetime, I can just about remember the Bank of England launching its lifeboat in 1973 in the secondary banking crisis and bailing out NatWest.
The central bank bailed them out?
The Bank of England, yeah. On that occasion. When I say bailing out, it's providing liquidity at that stage. Yeah.
So
keeping them afloat.
In
Nowadays, it's not what we would mean by bailing out now. what we'd mean by bailing out now would be recapitalizing them, and central banks don't do that in general. Governments do, but in 1973, that it called it its lifeboats.
So in 1973, when like what happened there? The Bank of England gave them liquidity. How did they print money basically, or how did they save them?
Remember that although the real economy was mostly working in cash at that time, even then, large payments and bank liquidity was at least partly electronic. So they would have provided them with money in some form. It might well have been actual physical money. I don't know the details of it, but I know they did provide liquidity to NatWest, basically to enable them to meet their obligations.
Okay, so there's, I guess, in the 80s as well, there was this real estate bank that was doing tons of risky real estate loans, and then
there's always a bank doing something. There's always a bank doing something risky and stupid. That's
and like the
BCCI. I mean,
like the FDIC in the U.S. has to like step in when a bank is failing and customer deposits are at risk, right? So they have to actually use the money in the trust or whatever the fund to either recapitalize the bank, or let it
deposits,
go. Yeah, so
they usually
banks that failed in the 80s.
are really efficient. I mean, they resolve banks over a weekend. They're really good. I mean, the customers never even notice, because what they normally do is kind of sort of get them going again, or do a forced merger or something, anything. FTIC are really good. I think they are the best bank resolution authority in the world, I think, FTIC.
So here's where I'm thinking, like, I'm still skeptical of all this stuff, and like the way that I've kind of been trying to learn as best I can as a naive Bitcoiner or whatever.
No, and it's really good that you are willing to learn, because one of my issues with the Bitcoin crowd right from the start is how unwilling lots of them have been to learn about how the system actually works, rather than their beliefs about how they think it works.
I think it's kind of because a lot of people do feel there's something wool being pulled over our eyes in some way by the banking system when they see bailouts happen. Sure. And even the Federal Reserve at times, like, they describe it as printing money, and we have an unlimited money printer and stuff. So they would
kind of like it if the Federal Reserve didn't use those terms.
Yeah,
I think it's not helpful.
If it's not actually printing money, then why are they saying, we got unlimited cash to print for you guys?
I do wish they'd think about the optics, the message that they're sending to people who are going, oh my God, Weimar, and coming up with pictures of wheelbarrows full of money. And I'm saying, but they're not actually printing anything. They're not actually printing anything that goes into the real economy, and they're massively inflating bank reserves, and they're giving loads of money to pension funds, but loads of cash to pension funds who don't know what to do with it. But there's no wheelbarrows of money being printed. It's nothing like that.
Well, I mean, I still haven't made up my mind, you know what I mean, yet. I'm trying to learn. I'm trying to be open to these ideas, but it does still feel like it's not fair, and it's not a good system of money.
I would totally agree that it's not fair. I mean, I think that's why I wrote the book, was right. I didn't think it was fair. I didn't think what they were doing was fair or right. It wasn't benefiting people much, and it was giving cover for banks that were doing things so actively harmful. I didn't think that was right. I think they should do things differently. But in order to say, I think you should do things differently, and this is what I think you should do, you kind of need to start from what people are actually doing. And if you don't understand what they're actually doing, then it's kind of difficult to say, well, you shouldn't be doing that, you should be doing this, isn't it?
Yeah.
So where I started from was, I actually understand what you're doing, and I disagree with it. This is what you're doing, and I then go into detail about this is what you're doing, and then I go, but you shouldn't be doing that. What you should be doing is this.
Right.
And I think that is, from my perspective, a stronger way of making an argument than to say, in effect, I haven't got a clue what you're doing, and I don't care, I just think it's wrong.
Right.
Which it amounts to what Bitcoiners say.
Well, a lot of us, I will agree that a lot of us have gone down the rabbit hole of like what money is from the perspective of gold bugs, and gold bugs and Austrian economists and stuff who teach you from a certain perspective of not a Keynesian view, but like an Austrian
Sure.
view, or some sort of mix of the two. But it's also that most Bitcoiners don't realize that we aren't in a Keynesian system either, because Keynes advocated for saving when times were good so that you could have reserves for like when times are bad, and doing helicopter money. But
Mm.
we're not in that system. We're in a system where they just continually suppress the interest rates and provide liquidity and monetize government debt and stimulate, even during times when they should be kind of like letting
Well,
things.
actually, that's not quite true, because roll back, we did have 2 years when the Fed was rolling off its balance sheet.
So let me continue my thing. You tell me where I'm wrong, because so I came from that understanding of that what happened with LTCM
Mm.
was the potential to cascade to the rest of the banking
Sure.
system, but they figured that one out. They went like the investors of LTCM lost a lot of money, and the bank,
Yeah.
the fund failed or whatever, but it didn't cascade to the rest of the banking system. In fast forward to like 2008-9, the great financial crisis, there was way too much leverage in the
Yep.
system through
Yeah, far too much.
derivatives and synthetic products and stuff like
Yes.
that. And all the major banks were involved in it. The
Hmm.
credit agencies were involved in it. Like you said earlier, it was a massive fraud. They were covering up this toxicity. But that had also happened in the 90s with when they started. I read the book Fiasco, which
Mm.
talks about all the toxic derivative stuff that they started to do in the 90s.
Well, you
And
should read. You should read about the what my father called the LMX spiral in the 1980s as well. That was insurance.
LMX.
Yeah, the London market excess. It's
Okay.
insurance. The collapse of the Lloyd's insurance market in the 1980s. The only other person I know who's written about this is the economist John Kay, who pointed out in 2007 that a very similar risk spiral appeared to be developing in the derivatives markets, and it was all going to end in tears. He was right. He wrote about it before it happened. He was one of the few to predict it, and it was because he said it was very like the London market excess spiral in the insurance market that nearly brought down the Lloyd's insurance market in the 1980s.
I'm gonna look into that because I love reading about these things. Because like I'm a Bitcoiner, I'm not a crypto guy, and I
Sure.
pay very close attention to what's happening in the rest of crypto and in DeFi. And to me, I really feel like DeFi is just rebuilding all the toxic stuff that's happened
Isn't
in
it
the past.
just? Yep.
Except they don't have a central bank to bail it out. So when it blows
Yes, they
up,
do.
it's just gonna blow
Yes,
up.
they do. Yes,
who's
they
the
do.
who's the DeFi central bank?
There's more than one. They are Tether, Circle, Pax Gemini.
Oh, you mean
What
the
am I?
stable
What am I
coins?
listing? Yes, they. In fact, I'm just writing halfway through a piece writing about this
Well, let's go
because.
back to that.
All right.
I do want to talk about that with you, but let me get through
Yeah,
my
we might have to
theory.
come back to it on another one, but let me write my piece about it,
Let's
because
do
actually
that.
it's quite
We'll do
important.
it.
It's quite important. Central stablecoin issues is why I think actually regulators are getting this quite wrong at the moment. And I've written about this on CoinDesk that I don't think they're getting this right. Stablecoin issuers act like central banks. Remember that we've talked about central banks as QE as a macroeconomic tool to prop up the real economy, and that it's quite good at arresting the disastrous asset price spirals and not quite so good at kickstarting growth and recovery, right? It's quite a weak tool, and I'd rather they did it differently. But central banks have another function too, and that's become increasingly important, and that is their role to provide liquidity to markets. Right now, in September 2019, the repo market froze. You've mentioned this a few times already, and it froze because those four big banks on which the market had come to depend as suppliers of liquidity to the market, cash, they could by lending their excess cash into the market, they're providing liquidity to the market. Agreed? Right? They'd come to depend on those four big banks. Meanwhile, the Fed had for the previous two years or so been running off its balance sheet. So there were fewer reserves in circulation than there had been 3 years before, quite a lot fewer. The Fed's balance sheet reduced by nearly half. At the same time, we'd had regulatory changes that forced those big banks to hold much more in the way of reserves. And particularly, it's not the LCR not the Basel rules, it's actually the Fed's living wills, were forcing them to keep their operational liquidity, these kind of 30-day forward cash flow projection that I've been talking about, forced to hold all of that in the form of actual reserves, not in the form of things that can be easily pledged in the markets for reserves.
Like HQLAs?
Yeah, so they couldn't hold them as HQLA, they actually had to hold them as reserves.
Okay.
Right? So obviously they had to hold far more reserves. And the final straw was in September 2019 when two things happened at once. The first was quarterly corporate tax filings. Now, normally those aren't a problem because you can see them coming, you know they're going to happen, you know you've got these big payments coming out, you can stock up on your reserves. The big banks would have covered that. What did them was the lifting of the debt ceiling and a massive increase in the Treasury issuance. When the government issues debt, the effect is reserve drain. I don't want to go into the technical specific.
Because they have to buy it with their reserves?
Yeah, absolutely. Because, no, actually, it's because within the central bank, within the Fed itself, money moves from Fed reserves into the Treasury General account, and that happens. It goes out of bank reserve accounts into the TGA because of the because the market has absorbed the debt.
On behalf of the central bank, or on behalf of the commercial banks, or on behalf of the Fed?
No, it's because, I mean, you've got your broker dealers who are buying the debt, buying the treasuries, and
with
then they might be selling them
reserves?
They may or may not. Most broker dealers aren't actually banks. It doesn't matter, but it doesn't matter because the purchases are intermediated through banks anyway. So the banks still have every time a commercial bank initiates a payment on behalf of a customer, the reserves move. So
to the Treasury General account.
Like in this case, to the Treasury General account, because the broker dealer is buying the debt that the government has issued, and it's paying for it with money that is intermediated through the bank. The bank pays the reserves, and the bank is transferring the reserves in effect to the Treasury General account, and the Treasury General account is not included in reserves. So, and that's what happened was these four big banks suddenly had these massive demands for reserve payments. It was 120 billion, right? And they didn't have enough reserves, so they stopped lending.
Right. Okay.
They stopped lending to the markets, and the markets froze. It was a complete liquidity drain, and it was a sudden massive liquidity drain in the market. And so the Fed had to step in effect, to buy up a whole load of treasuries, to get some liquidity into the markets.
That way that you've described that, is that the consensus view, or like how?
Yeah.
So, like, whether
there are differences of opinion about exactly what happens, but there's evidence for this. There's a whole paper about there's a whole, and there are issues about how the market became so dependent upon those banks, which is to do with regulations applying to money market mutual funds and some stuff about sponsored repos and stuff like that. You really don't want to get into, but the proximate cause was these four big banks suddenly stopping lending to the markets because they'd got these massive payments coming up, payments to the government coming up, taxes and the TDA and the treasuries, the debt issuance.
Has anyone else had any kind of other credible hypothesis of why the repo markets froze up?
Well, actually, this was kind of Randall Quarles. I'd take him seriously, wouldn't you? He was on the FOMC at the time.
I don't know.
And the Bank for International Settlements. So, I mean, I wrote about this at the time. There's I read blog post about it, but I used as my evidence what BIS was saying and what Randall Quarles was saying, and the general evidence from the funds movements, the things you can see. And there's also some work, I think, by a guy called Nathan Tankus who's written about this as well. We think we are pretty much in agreement. The problem was this sudden drain of reserves from the four big banks to the government, one way, because of these quarterly tax payments, combined with this sudden very large increase in treasury debt issuance, and with the background and regulatory changes that made the market more dependent upon cash lending from these big banks, and a generally scarcer set of reserves because the Fed had been running off its balance sheet. Okay, that's September 2019. Now, if you look at what happens in crypto markets, right, when the crypto price falls, right, people are selling, and they're often cashing out into stablecoins. Agreed? So if your Bitcoin price is falling, people are selling.
I would say, yeah, on exchange accounts, probably they're holding it in database coins, whether it's.
Well, there are two parts to this. One is actually that when cryptocurrency price volatility is high, demand for stablecoins increases.
Sure.
Right.
Yeah.
Yeah, and you see
are you
that
talking about in DeFi or just in the
no,
market?
generally, no. This is
Okay.
exchanges. I'll get onto
Right.
DeFi in a minute because DeFi is part of this. DeFi is a bit like what I was saying about the background to this is the structural
Right.
changes in the market and other stuff going on. So here I'm just talking about what's happening on exchanges when cryptocurrency price volatility is high.
Yeah,
Stable
people
coin.
want to fly back to dollars of some sort, whether
Exactly,
it's
and they do
USD or
that by
USD or
yeah, and because it's
whatever
actually
token they represent a dollar.
exactly. So because actual dollars, are quite hard to handle on crypto exchanges, on ramping them is difficult, and off ramping them is even more difficult, and banks don't want to cooperate. And okay.
Exactly, yeah.
So everybody uses stablecoins, don't they? Which is totally understandable. I've used them myself. I mean, you just would, wouldn't you? Because it's so much easier. So when cryptocurrency price volatility is high, the demand for stablecoins rises. You can see this because it's quite not uncommon for when, say, Bitcoin price is falling rapidly. You can see that stablecoins can go above their peg for a while.
Yeah.
Yeah, and then the stablecoin issuers issue a whole load more stablecoins. I mean, they print billions. Jeremy prints like $1 billion USDC or something, right? And then the stablecoin gets back onto its peg, or sometimes comes below it. And around that time, often sometimes you find that exchanges put limits on withdrawals, or they might even close down completely. Or scheduled maintenance is a wonderful thing. And then the stablecoin issuers issue a few billion more liquidity. Yeah. And then the exchanges open up again, and the stablecoins get back on their peg, and kind of normal service is resumed. And you normally then also find that the whole market calms down, and the cryptocurrency prices stabilize as well, and normal service is restored. So stablecoin liquidity is awfully important to exchanges, and there have been several episodes where it's very obvious that stablecoin issuers are providing liquid to the markets to relieve liquidity shortages due to cryptocurrency price volatility. You can see that happening.
I don't think I follow that, Francis, because what I think that, like, when exchanges go down during volatility, it's actually more like they're operating like bucket shops and they're trying to liquidate their customers and make money.
Well, they
Like
might well be doing
BitMEX.
that. They might well be doing that as well, but I'm being kind here.
Well, no, we don't need to be kind. Like, but BitMEX is unregulated, and
Oh, sure.
they're
No,
being
but I'm talking about even the sort of the big exchanges. I mean, whether they're trying to rip their customers off. I know.
Coinbase, for example, I think Coinbase is more just like they went down during the Super Bowl. It's they just like they have problems staying up.
Look, I deal with the banking system, right? Okay,
Yeah.
I know that when a bank has liquidity problems, it closes its doors.
Right.
I see crypto exchanges, which are banks, which are behaving just like banks, really.
But crypto exchanges, the money that's happening, like the trading that's happening on crypto exchanges, is just database entries. It's not actual liquidity.
What do you think activity, payments activity in banks is?
Right. But they
it's database entries. Everything is database entries.
Right. But it's like
just a different type of database.
I guess, like, I'm trying to find where, like, why would an exchange need an injection of stablecoin liquidity if they've already got it all in their system?
Because they don't have enough. And because your stablecoins are pegged, right? They're holding a dollar peg. They're a 1-for-1 par peg. In the case of banks, remember I said to you that you have a guarantee. You can withdraw your money from your deposit account, and you will guarantee to get 1-for-1, right? That's not guaranteed for money market funds, by the way. If it's a run on a money market fund, you don't get all of your money back. Right? But with stablecoin, you've got the same kind of par peg, and it's not guaranteed by the central bank, right? So if you've got liquidity, if you've got stablecoin shortages on an exchange because everybody's cashing out into stablecoins, then the stablecoin is going to depart from its peg.
But people aren't actually like withdrawing the stablecoins. They're just trading to the stablecoin and still keeping it on the exchange.
Yes, I know, but the price of the stablecoin is going to rise.
The price of the stablecoin will rise because there's an
Right.
influx of demand for the coin, so it slightly goes above the peg because there's more people
Right. Well,
trying to
that's not
get
much
at
use
it.
for that's not much use for a stablecoin, is it? Because it's not very stable. It's stable if it's coming off its peg. So, but
I mean,
anyway,
I would say I
I
would say
mean,
like a 0.5% peg movement or something is not too big of a deal. It did get
look,
down to like 90
my
cents at one
point
point.
is, look, it kind of doesn't matter. Yes, I mean, okay, crypto exchanges may or may not be closing down because they've got liquidity problems. It may be they're just not handling the volumes very well or whatever. But there is a pattern of cryptocurrencies closing down for scheduled maintenance when
Right.
Bitcoin's price is falling. I'm sorry, but there
Or
is.
rising. Or
Or
rising.
rising
Like,
when price volatility, yeah, absolutely, when price volatility is high,
yeah.
cryptocurrency price volatility is high, cryptocurrency exchanges don't
Yeah.
cope with it very well for whatever reason.
I
Part of that,
think it's because they're trying to liquidate people on the short and the long
you
end of
might
it and
well be
make
right.
money.
It might also be because they just can't handle the volumes of trades. Their apps aren't very good.
Yeah.
It might be because they've got liquidity problems. They haven't got enough stable coins. I don't know.
So
Um,
I asked Paulo from Tether just last week about this because I started to kind of suspect that Tether was acting like a central bank in a way
it
and
is.
taking well, so here's the story. So there's this thing Celsius. You're familiar with Celsius?
Yes.
So Celsius does all
Celsius
kinds
is
of
Celsius is actually a bank. I mean, it's not a
yeah,
regulated bank;
I
it's a
mean they're
shadow
acting
bank.
like a
Yeah,
bank. They're
they are.
acting
Yeah,
like a bank. And a lot of us Bitcoiners do not like Celsius. We don't recommend people use
I
Celsius.
don't like Celsius.
I mean, their CFO was arrested for fraud recently, and they've been kicked out of Prime Trust as the custodian in the last year. They lost like $100-something million in some DeFi coin thing that they got hacked. Like they're continually doing a lot of risky stuff. They're
Yeah.
doing rehypothecation of customer assets.
Yes.
Plus, they've got regulatory risk because of the Celsius token, which is an illegal security. So there's all kinds of problems for putting your money in Celsius. But yet still they've gone and raised all this money from institutional investors who've apparently done due diligence and see everything's fine. But I think it's just too risky for me to be involved or recommend anybody be involved with Celsius because it kind of feels like it's going to blow up at some point. But Celsius got $1 billion or so, a large amount of Tether. And I was starting to suspect that, and well, not me, but other people were starting to suspect that Tether was bailing out Celsius and providing them liquidity in
It could well be.
exchange for like corporate paper, just loans or something like that, and they print $1 billion Tethers and send it to them. So there was also like there's other things in DeFi that use Tether, and people were suspecting that maybe Tether is printing Tethers from nothing, but like from loans or promises to repay later or whatever, like very high risk collateral, corporate paper, whatever, and giving Tethers, which have confidence in the market of $1. So if that's happening, they're actually kind of bailing out these risky DeFi things. And so to me, like as a Bitcoiner who thinks everything that's happening in DeFi is rebuilding all the problems with Wall Street and all the toxic risk of Wall Street, but putting it on a blockchain, I wanted to find out whether or not that was really happening. And apparently they're saying no. They're saying that they don't do that. They only do over collateralized loans to companies like that. But if you want, we can like.
Remember what I said about over collateralization, that we've been doing
Yeah.
this since the year dot. Everything that banks borrow from central banks is over collateralized. It's what we call a haircut, right?
Right.
So the over collateralization isn't the safety net that you think it is. It's just normal.
Right. Yeah. If things drop a lot, which they can in crypto,
if I've got a haircut of 50%, I've got over collateralization of 200%.
Right.
Can you see that?
Yeah.
Right.
But how about like we've been going for 2 hours now? I think we should do another podcast and kind of like.
We definitely need to, because my other half's just arrived home and he's going to just sit and have a cup of tea and watch the television for a bit. So I'm going to need to go.
I really appreciate it. Thank you for your time, and I'm gonna try to go through your book, and then maybe we do a second podcast after I go through the book.
That would be really good fun.
And
It's been fun.
you'll have your DeFi thing written, and I'll read that too, and then we can discuss that.
Yeah, I'm definitely going to write about this. I mean, I might play down the cryptocurrency exchanges thing, but definitely they're providing liquidity to exchanges. And the background to this, which I didn't mention, is the way in which DeFi absorbs stablecoins, because it's using stablecoins as collateral.
Yeah.
And
that's
the
a whole
fact
conversation.
that's
DeFi
a whole
side
conversation in itself. That DeFi is withdrawing stablecoins from circulation by locking them up in staking pools all the time. I mean, it is absurd the number of stablecoins that are disappearing into staking pools and never being seen again. Celsius rehypothecates them, but most of the staking pools don't, as you know. They're vaults, and I know there've been discussions about how you can get your collateral out of staking pools, but out of the vaults. But really, you're just locking up enormous quantities of stablecoins pretty much as soon as they're issued. And so your stablecoin issuers are having to issue more and more stablecoins just to keep the markets liquid. Can you see that? The more you use something as collateral, the less liquid it becomes.
Yeah, and there's even more complicated stuff with the DeFi, like curve pools and all that stuff, where there's algorithmic coins that are actually just faith-based pegs. They're not actual backed by anything in a bank account anywhere. It's just algorithmic.
Oh,
and that's
absolutely.
growing to tens of billions of dollars. Those are the equivalent of derivative synthetic mortgage-backed securities, in my opinion.
We've got a lot of synthetic stuff going on in there, and the whole thing, I mean, it's just this massive house of cards that's being built, and it could collapse just like 2008. There's no reason to suppose that it wouldn't. And I know they keep appealing to over collateralization. I keep going, we had haircuts in 2008 too.
Yeah. I think it's going to blow up, and I think there is no actual equivalent.
But I think you're right. I think you're right in that respect, but my concern is more that when you build a system that is entirely collateralized, heavily collateralized, and over collateralized, you actually make it very illiquid. And so if you have no way of getting your collateral moving, and if the thing you're using, if the thing you're using as collateral is also your principal medium of exchange, which is what your stablecoins are, then you're gumming up the works all the time, and your only way of keeping it moving is to keep on is for issuers to keep on pumping more liquidity into the markets. Now that's what's happening with the effect of DeFi on stablecoin on exchanges, and why there's this kind of apparent chronic shortage of stablecoins going on, which is why interest rates on stablecoin lending are so high. They're anomalously high for what they are. I mean, they should not be higher than interest rates on lending Bitcoin, but they are massively.
I think that's pretty much fraud too. All that high interest stuff. I mean, I
don't think it's fraud. I think it's simply reflecting this serious scarcity of stablecoins, because the demand for stablecoins as collateral in staking pools, but that's constantly taking liquidity out of markets, and so stablecoin issuers are constantly having to put more in, and yet there's still this chronic demand going on. It's a huge kind of sort of loud sucking sound as the stablecoins are constantly being sucked out as fast as they're being put in.
The reason why I think it's a fraudulent type of activity is because it's all mixed in with these illegal securities, these
coins, for sure, and there's
rehypothecation
going on and all kinds of stuff. But then
that's what is paid out, at least half of the interest, sometimes 80-90% of the interest that you're earning is actually these shit coins that you're getting given, these illegal security coins.
Absolutely, because nobody's got any actual money.
But anyways, let's
but we'll talk about this another time. But did you see what I was getting at with the way in which DeFi is sucking liquidity out of the market in the time? And the only way you can keep your markets moving then is for your stablecoin issuers, your medium of exchange issuers, to keep on pumping liquidity into the markets. And that's what the likes of Tether and Circle and so forth are doing. So it's like the Fed on steroids. I mean, the Fed is having to pump liquidity into markets because things are becoming very over collateralized. We've got a lot of cash collateral going on in conventional markets, and that's getting locked up as well. But
yeah, they're acting like a central bank, but they are not a central bank, and they're not going to be able to stop a collapse. They don't have the power, the true power of a
absolutely.
central
They're
bank.
acting like a central bank, but they're not a central bank, and I think that's a really important insight, and one we can unpack further when we meet again. That would be good.
All right. Well, thank you very much.
It's been a pleasure. It really has.
Yeah, thank you.
Okay, take care then.
Bye.
Bye.